Good morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. And of course, Friday, big exciting news. The Federal Reserve comes out at their Jackson Hole Summit. Jerome Powell saying, yeah, we're going to taper later this year, but not raise rates really kind of anytime soon. Long way to go. That got the bulls very excited here. And of course, we broke out the marginal new highs. Now, importantly, as we've been talking about here as of late, watch what's going on with volume. On the sell-off days, we're seeing pickups in volume, right? More sellers showing up to sell on those days where we have a sell-off in the markets. However, take a look here closely. Every time we get rallies in the markets, we get a drop in volume. Again, the internal breadth of the market remains very weak. Volume remains weak. Volatility remains very compressed. The advanced decline lines below the 50-day moving average, the number of new highs versus new lows, all signal a very kind of weak internal market. More and more people crowding into fewer stocks. That's really what's keeping the market lifted, primarily because those stocks are your major market capitalization stocks: Apple, Facebook, Google, Amazon, etc. Now, that's what's keeping the market lifted up here, and that's fine. There's nothing wrong with that, except for this fact is that if we do get a point to where we start getting a change in sentiment, where you start getting sellers show up on a regular basis and buyers don't, you are going to get a bigger decline here. Now, importantly, the last time that we actually saw a market that was up for 12 months in a row with very low volatility, that was in 2017. The year of 2017, very low volatility year, and looked very much like we have currently over the last 12 months, which has been these just retests of the 50-day moving average, and importantly, a very nice parallel trend between the 50-day and the 200-day moving average. That is 2017. Nothing wrong with that. Of course, 2017 was a good year. It was up about 30%. We're on track to do the same thing again this year. But just remember also that when we got into 2018, lots of volatility through 2018, culminating in that 20% sell-off that we had at the end of the year when the Fed dropped interest rates. The problem now for the Federal Reserve, of course, is that as markets are lifting higher here, still keeping the pedal to the metal, so to speak, in terms of $120 billion a month in QE, keeping interest rates at zero. So again, the further they inflate the market here, if we begin to see signs of weakness, the Fed's going to have a lot of problem here because they really can't expand QE further, can't lower interest rates any further. So again, they may very well be getting themselves in a box in terms of monetary policy. And if the economy begins to weaken, they have very little left to work with at this point to stall off any bigger decline. Nothing wrong with any of this, of course. Markets still remain very bullish here. No reason to be overly concerned at the moment. But again, continue to watch this 50-day moving average. That's going to be your first big warning sign of a bigger correction coming if we do break that trend and hold below it. Again, I'm Lance Roberts with 3 Minutes on Markets and Money. We'll see you tomorrow.